You opened your brokerage app. The market was down, your portfolio was red, and something inside you just snapped. Maybe you told yourself you could handle it. Maybe you promised yourself you were a long-term investor. But in that moment, with your hard-earned money sitting there bleeding out on a screen, every rational thought you ever had about investing just disappeared. And you sold. Or maybe you almost sold, or maybe you're watching this right now because you're staring at a red portfolio and you genuinely don't know what to do next. I want you to know something. What you're feeling is not weakness, it's not stupidity, it's not a character flaw. It is the most predictable, most documented, most studied psychological response in the entire history of financial markets. And understanding exactly why it happens is the single most important thing you can do before you make a decision that could cost you years of progress. Because here's the uncomfortable truth that nobody talks about. Most beginner investors don't lose money because of bad stock picks. They don't lose money because of bad timing. They lose money because of what they do when the market drops. And the market always drops. Always. That part is guaranteed. What is not guaranteed is how you respond to it. Let me paint you a picture. You spend months saving money. You research your investments. You feel genuinely proud of yourself for taking this step toward building your future. You watch your portfolio grow a little. You start to feel like maybe this is actually working. And then one morning you wake up, you check your phone, and everything is down. Not just a little. We're talking 5%, 10%, maybe more. And suddenly that pride you felt just days ago feels like a distant memory. Now it feels like a mistake. Now it feels like maybe you should have just kept the money in your savings account. Now it feels like the people who told you investing was risky were right all along. That feeling right there, that specific feeling, that is the moment where beginner investors make the most expensive decisions of their lives. And I need to stop here for just a second because I want to say something directly to you. If you are someone who is serious about changing your financial future, who actually wants to build real wealth and not just learn about it in theory, we have a program linked in the description below this video. People who go through it don't just understand investing better. They respond to markets better. They make fewer emotional decisions. They stay in the game when everyone else is panic selling. I'm mentioning it now because the information in this video is important, but information alone has never made anyone wealthy. Application does, execution does, guidance does. Check the link when you're ready. Now let me keep going. Here is what actually happens inside your brain during a market dip, and this is where it gets fascinating and terrifying at the same time. Your brain does not experience financial loss the way it experiences financial gain. This is not a metaphor. This is neuroscience. Losing $100 activates the pain response in your brain at roughly twice the intensity of what you feel when you gain $100. Which means the market dropping 10% does not feel 10% bad. It feels catastrophically bad. It feels like an emergency. It feels like you need to act right now before things get worse. And that feeling of urgency, that desperate need to do something, anything, is the exact mechanism that makes beginner investors sell at the worst possible moment. Think about what that actually looks like in practice. The market drops. You panic. You sell. You lock in your losses. The market recovers. You watch from the sidelines with your cash sitting in your account. You wait for a perfect moment to get back in. The market keeps climbing. You're still waiting. And then weeks or months later you finally buy back in, usually at a higher price than where you originally sold. You have now officially lost money not because the market crashed, but because of the sequence of emotional decisions you made during the crash. This is called getting whipsawed, and it happens to beginners constantly. Not occasionally, constantly. But here is where I need to really slow down and be honest with you, because I don't want to make this sound simple when it isn't. There is a specific type of pain that comes with watching your portfolio drop that is almost impossible to describe to someone who hasn't felt it. It's not just the money, it's what the money represents. It's the hours you worked to earn it. It's the sacrifices you made. It's the version of the future you were building in your mind. When that number goes down on the screen, it doesn't feel like an abstract financial percentage. It feels like your dream shrinking. It feels personal. It feels like a judgment. And if anyone in your life told you this was a bad idea, if a parent, a partner, a friend raised their eyebrows when you said you were going to invest, that voice gets so much louder when the market drops. Suddenly their doubt feels like prophecy, and your confidence feels like arrogance. And the desire to just get out, to stop the bleeding, to protect what's left, becomes almost overwhelming. I've seen this pattern play out more times than I can count. And every single time, the people who survive it are not the ones who had better information. They're the ones who had a better framework. They understood what was happening and why. They had context that transformed panic into patience. So let me give you that context right now. Market dips are not anomalies. They are part of the system. Historically, markets experience a correction of 10% or more roughly once every year or two. Bear markets, which are drops of 20% or more, happen approximately every 3 to 5 years. And every single time, without exception throughout history, markets have eventually recovered and gone on to reach new highs. Every single time. That sounds simple when you say it out loud. But knowing that fact intellectually and actually being able to sit with a red portfolio without making a panic decision are two completely different things. The gap between knowing and doing is where beginner investors lose everything. Here's another pattern that destroys beginners, and this one is sneaky. It's called performance chasing. When the market is rising, new investors flood in. Everyone is excited, everyone is making money. Confidence is high. And then when the market corrects, those same people who bought near the top are now holding the biggest losses. They feel the most pain, they're the most likely to sell, and they do, right at the bottom, right before the recovery. The investors who build wealth over time are not smarter. They are not luckier. They simply stayed while everyone else left. Let me shift gears completely because I want you to really feel what's on the other side of this. Imagine you are 5 years from now. You stayed invested through every dip, every scary headline, every moment where every instinct you had was screaming at you to sell. You didn't. You kept going. You kept contributing. You kept holding. And now you're looking at your portfolio and the number is not what you started with. It is 2, 3, 4 times what you started with. And that version of you sitting there 5 years from now is not congratulating themselves for picking the perfect stocks. They are thanking themselves for not selling during the dip of a year or two ago when it felt impossible to hold on. The single biggest financial decision of that person's life was not what they bought. It was what they didn't sell. That is the wealth building version of this story. And it is available to you right now with what you already have. The only thing standing between you and that outcome is your behavior during the hard moments. Now I want to talk about something that most investing content completely ignores, and that is the cost of confusion. When you don't fully understand what you're holding and why you're holding it, every piece of bad news feels like a direct threat. Every dip feels like a reason to reconsider everything. You become vulnerable to every headline, every opinion, every friend who says they heard something. You second-guess every decision. You lose sleep. You check your portfolio 20 times a day. You're not investing anymore. You're just anxiously watching numbers move. And that anxiety has a cost, not just emotionally, financially. Because anxious investors make reactive decisions. And reactive decisions in investing are almost always wrong. The research is overwhelming on this. Individual investors consistently underperform the very funds they invest in because they buy high when they're excited and sell low when they're scared. The solution is not discipline alone. Discipline without understanding is just white-knuckling it through every dip hoping you'll survive. Real stability comes from understanding, from knowing exactly why you own what you own, from having a clear picture of where you're going and how you're getting there. When you have that, a market dip stops being a crisis. It starts being exactly what it is, a temporary fluctuation in a long-term journey. People who have that kind of clarity don't just invest better, they live better, they sleep better, they make better decisions across every part of their financial life. The compounding effect of that clarity over months and years is genuinely life-changing, and the time you save by not spending your days confused and anxious and second-guessing yourself is time you get back. Time with your family, time for your work, time for things that actually matter. Good investing is not supposed to consume your life, it's supposed to work in the background while your life gets better. So here's where I leave you. You now understand why beginner investors lose money during dips. It's not stupidity, it's not bad luck, it's psychology, it's emotional decision-making, it's the absence of a framework that keeps them grounded when things get uncomfortable. And you also know that the investors who build real wealth aren't the ones with perfect timing. They're the ones who showed anyway when it was hard. The question is what you do with this, because you can watch this video, nod along, feel like you learned something, and then the next time the market drops, feel every bit as panicked as you did before. Information without structure fades. It fades fast, and the next dip will test you the same way the last one did. Or you can take the next step. The program linked in the description below this video exists for exactly this reason. Not to overwhelm you with theory, not to turn you into a day trader, but to give you the kind of foundational clarity that actually changes how you behave when the stakes are real. The people who go through it stop making fear-based decisions. They stop second-guessing everything. They stop watching their portfolios crash their confidence every time there's a red week. They finally feel like they know what they're doing. Most people will watch this video and do nothing, and that's fine. But if you are the kind of person who is actually ready to stop hoping things click and start making sure they do, the link is right there. Go look at it right now, before the next dip catches you unprepared again.